Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about the health of high turnover businesses. One business in particular that's been hard hit during the pandemic is senior housing. Under normal circumstances, those entering assisted living are there on average for about 3 years. Some facilities offer respite care, but most residents are there until they move into skilled nursing facility, or if they decline quickly, they go into hospice. Senior housing relies on a continual flow of new residents coming into the homes to maintain their occupancy. Generally speaking, there's been a lot of construction of new senior housing in anticipation of the baby boomers aging out of their homes. It's expected that the size of the senior housing industry is going to double over the next decade. So much of this excess supply would eventually get absorbed. So here we are in 2020 in the middle of a pandemic that has impacted many senior care homes. The stories of homes that have been devastated by outbreaks of COVID-19 have made headlines all over the world. There have been only a handful of really badly managed situations of acute staff shortages and resident neglect and high death toll. And on the other hand, the vast majority of facilities have continued to be well run and have not experienced any outbreaks. But the headlines have stigmatized the industry as a whole. We're now 7 months into the pandemic, and a number of residents have left the assisted living community where they've resided. This may have been due to a deterioration of a pre-existing condition, might have been as a result of COVID-19, or it may have been a result of family pulling mom or dad back home. Senior facilities continue to operate under strict lockdown protocols. That means that someone new coming into a facility must quarantine for 14 days, and after that, they may have contact with other residents in the facility, but families still barred from visiting indefinitely. The lack of human contact for the elderly can be emotionally devastating. Families are simply not electing to put a family member into assisted living under these circumstances. And while facilities have been open to accepting new residents for some time, the number of new residents has been a trickle compared with normal conditions. That means that the senior housing industry as a whole is going to experience declining occupancy until well after the pandemic is over. Some newer facilities were in the middle of their lease-up when the pandemic hit. They're really suffering. We're already starting to see signs of financial distress in the industry. Senior housing is expensive to build. The big box operators are generally building new product at a price point of about $500,000 a unit. Now, that seems like an incredibly high number. Our own residential assisted living product is being constructed for a total cost of under $200,000 a bed. There will be a deluge of big box facilities coming on the market, selling for well below replacement cost. So there will be bargains in the industry in the coming months. Now, hundreds of senior housing communities halted admissions during the pandemic to protect residents against a virus that has been particularly deadly to the elderly and those with comorbidities and other health problems. That's meant lost revenue at a time when the pandemic-related costs have soared. Now, a shaky reopening proceeds in various geographies. Many of these communities have started admitting new seniors, but the reopening of admissions has not led to a surge in move-ins and rising occupancy, as many had predicted. According to a report in Senior Housing News, 53% of communities are continuing to report declining occupancy. Ventas is a large national operator. They've seen occupancy drop from 85% in some of their facilities to about 80% since the month of April. Welltower, another large player with 612 senior housing operations, in their portfolio reported 79.4% average occupancy for its portfolio in July, a significant decrease from 85.8% occupancy that it reported in February before the pandemic hit. Now, we believe that big box operators are going to get aggressive in their marketing in the coming months as they try and fight for market share under these challenging conditions. We also believe the economic model is going to change. The number one cost in assisted living is staff, and labor costs are on the rise in the industry as caregivers and personal support workers demand higher wages to compensate for the added costs and risks associated with working in the pandemic environment. These higher costs are ultimately going to be passed on to customers, except in those cases where there's a government or insurance contribution. Labor rates are rising faster than the cost of living allowance that both government and insurance have built into their rates. The result will be a profit squeeze for operators, and some who are already suffering due to low occupancy will get hit again as their profit margins are eroded due to higher labor costs. We're observing that the residential assisted living model is going to be the big winner coming out of the pandemic. The lower density environment and the ability to better manage the number of people entering a building is a significant differentiator when it comes to managing pandemic safety protocols. As you think about that and you're looking at making a possible investment in senior housing, pay very close attention to what's happening in the industry both locally and on a large scale. Have an awesome rest of your day. Go make some great things happen. I'll talk to you again tomorrow.